Hi, everyone, and welcome to Tips Tuesday. I'm Brian Samuels, Principal and Senior Consultant at Fiducient Advisors, and today's tip is about inverted yield curves. If you've been consuming financial media in recent months or simply reviewing the savings account and CD rates where you do your personal banking, you're probably aware that short-term interest rates are high, approaching or exceeding 5%. With savings rates hovering near zero from 2009 to 2016, and again more recently from 2020 through early 2022, getting a real return on cash has been a welcome turn of events for both institutional and private investors. While some are pleased, other investors who observe and invest based on the entire Treasury yield curve likely have more mixed feelings as they are concerned over the current shape of the yield curve, namely that the curve is currently and somewhat significantly inverted. Let's take a step back and discuss a more normalized yield environment. The yield curve is a snapshot of bond market yields, showing the interest investors may expect to earn from bonds with different maturities, from short-term one-month T-bill rates all the way out to 30-year Treasury bond rates. Generally, in a normalized environment when investor sentiment regarding the U.S. economy is positive, the shape of the U.S. Treasury yield curve is upward sloping. On a personal basis, this means that you would expect to earn a higher yield on a one-year bank CD than a six-month bank CD, as you would expect to be paid a higher rate to allow your bank to lock up your money for a longer period of time. For institutional investors, we expect to be paid a higher interest rate for bonds with longer maturities than shorter maturities, as longer maturity bonds have more interest rate sensitivity and their prices will vary more with changes in interest rates than bonds with shorter maturities. These notions probably feel like common sense. This is not the yield environment we find ourselves in today. Here today in 2023, and since July of 2022, markets are observing an inverted yield curve. As of the date of this recording, 6 months yields are higher than any yields further out on the yield curve, out to 30 years to maturity. In other words, investors are being paid more to take on less illiquidity and less interest rate risk. If this feels counterintuitive, it should. If an upward sloping, properly functioning yield curve is an indicator of positive investor sentiment regarding the U.S. economy, then an inverted yield curve must mean the opposite, which many market participants believe it to be. In fact, an inverted yield curve, specifically an inversion of the 2-year maturity Treasury rate and the 10-year maturity Treasury rate, is a reasonably accurate and commonly used indicator for predicting U.S. economic recessions. Recessions in this case being formally defined as 2 consecutive quarters of negative gross domestic product or GDP growth. In terms of reliability, the 2-10 spread has inverted 28 times since 1900. In 22 of these instances, a recession followed. The indicator has been even more accurate in recent history, as the last false positive occurred in late 1998 after the Russian debt default. Over the past 50 years, it has taken an average of 12 months from the beginning of a yield curve inversion to the beginning of a U.S. recession. Before the most recent 2-10 inversion, which started in July of 2022, the last time the 2-10 part of the curve inverted was in 2019. The following year, the United States entered a recession, albeit one predominantly caused by the COVID-19 pandemic. Today, 2-year yields are nearly 80 basis points higher than 10-year yields, a level of inversion that hasn't been seen since 1981. Magnitude of inversion does not, however, necessarily correlate with the severity or longevity of historically following recessions. We encourage investors to use today's inverted yield curve to reassess the cash and fixed income portions of their portfolios. Trying to time a U.S. recession and the resulting market environment is a nearly impossible task, as it is equally as difficult to time the moves made by the Federal Reserve. However, we feel that investors will be wise to reconsider short-term cash equivalent investments and short-duration fixed income in their portfolios, given the current risk-return opportunities. That's it for today. Please visit fiducientadvisors.com for more of our research and insights or to learn more about the firm.